And you have been saying for quite a long time that the financial situation here was precarious. Dead right. Closes $6 billion in revenue still up for grabs. Share donor to everybody, especially Target, which is next door to a lot of them. What I thought was most interesting is that they're in 8 different real estate investment trusts. You know, David, that every single one of them has demand for these spaces because there hasn't been that many companies that have gone away. So positive for the REITs, surprisingly, positive for Target, and negative for the fact that this was one of the worst run companies I've.
Imagine this, it's the early 2000s and you're out shopping. Bed Bath & Beyond was the go-to place for all things home goods. From towels to kitchen gadgets, this store had it all. But fast forward to today and that once dominant retailer is gone. How did they go from thriving to filing for bankruptcy? Let's take a look into the rise and fall of Bed Bath & Beyond. Bed Bath & Beyond was founded in 1971 by Leonard Feinstein and Warren Eisenberg. They had both left their jobs at a struggling department store, determined to start something new. Their vision? A small specialty store focusing on bedroom and bathroom products. The first store, called Bed & Bath, opened in Springfield, New Jersey. It wasn't an immediate sensation, but it gradually built a loyal customer base by offering quality products at competitive prices. Throughout the 1970s and 1980s, the company expanded steadily, growing from 1 store to 17 by 198. The competition was tough, with similar stores like Linens and Things popping up. To stand out, Feinstein and Eisenberg decided to take a bold step. They started opening larger superstores and rebranded the company as Bed Bath & Beyond. This move was risky, but it paid off. Offering customers an extensive variety of products under one roof was a major draw in the pre-internet age. By the late 1990s, Bed Bath & Beyond had become a household name. Their success was fueled by several key factors. First, their superstore model allowed them to offer an unparalleled selection of products, from basic home essentials to more luxurious items. This variety attracted a broad customer base, making Bed Bath & Beyond a one-stop shop for everything home-related. Another cornerstone of their success was their minimal spending on advertising. Instead of flashy ads, they relied heavily on word of mouth and customer experience. And of course, who can forget the iconic 20% off coupons? People would hoard them, knowing that a trip to Bed Bath & Beyond wasn't complete without a coupon in hand. The store layout also played a significant role in their success. With tall displays and clearly marked sections, customers could easily navigate the store, which gave the impression of a vast inventory. Behind the scenes, Bed Bath & Beyond's decentralized inventory management system saved money. It allowed individual stores to adjust their stock based on local demand. This strategy, combined with organic expansion, where profits were reinvested into new stores rather than risky acquisitions, helped the company grow rapidly. By 2018, Bed Bath & Beyond reached its peak with over 1,500 locations and $12 billion in annual sales. They were riding high, making the Fortune 500 list and becoming the go-to destination for anyone looking to outfit their home. However, the retail space was changing, and Bed Bath & Beyond struggled to keep up. The rise of e-commerce, particularly Amazon, posed a significant threat. Consumers no longer needed to visit a physical store to buy what they needed. They could order online and have it delivered to their doorstep within days. Bed Bath & Beyond was slow to recognize this shift, and their online presence remained weak. By 2012, online sales made up just 3% of their total revenue. The company's vast inventory, once a strength, became a liability. Maintaining such a large selection was costly, and the decentralized approach that once worked well started to show fall. Stores were often overstocked with items that didn't sell and understocked with popular products, leading to frustrated customers. Moreover, Bed Bath & Beyond relied heavily on third-party intermediaries for supply chain management, which increased costs and made it difficult to compete with Amazon. In 2019, Mark Tritton was brought in as CEO with a mandate to turn the company around. Tritton, known for his success at Target, had big plans. He aimed to modernize the stores, reduce clutter, and introduce private label brands to boost profit margins. However, these changes were met with resistance. Customers walked into stores expecting the familiar brands they had trusted for years, only to find new, unfamiliar names. The sudden change caused sales to continue to decline. Then, the pandemic hit. Already struggling, Bed Bath & Beyond was dealt another blow as stores were forced to close, supply chains were disrupted, and the company's financial situation worsened. Tritton's turnaround plan, which relied on physical store improvements and private label brands, was ill-timed. By 2022, the company had reverted many of these changes, bringing back name brands and increasing the use of coupons. But the damage was already done wisely. However, in Bed Bath & Beyond's case, it drained resources. In 2014, the company issued $1.5 billion in bonds to fund these buybacks, pushing itself deeper into debt. Over 20 years, Bed Bath & Beyond spent almost $12 billion buying back stock at an average price of $44 per share. Unfortunately, this strategy backfired, and by 2022, the company's market value had plummeted. The rising debt, combined with increased competition and poor strategic decisions, left the company in a precarious position. In June 2022, Sue Gove was appointed as interim CEO to stabilize the company. Gove reversed some of the previous CEO's decisions, bringing back familiar brands and ramping up promotions. Despite these efforts, the company's financial situation was dire. By early 2023, Bed Bath & Beyond was on the brink of collapse. The company announced a $1 billion stock offering in a last-ditch effort to raise funds, but it wasn't enough. On April 23, 2023, Bed Bath & Beyond officially filed for Chapter 11 bankruptcy with over $5.2 billion in debt. The once mighty retailer began liquidating its remaining assets, closing all 360 Bed Bath & Beyond stores and subsidiary bbby locations, marking the end of an era. Just when it seemed like Bed Bath & Beyond was gone for good, Overstock.com stepped in. In a surprising move, Overstock purchased the Bed Bath & Beyond name for $21.5 million, transitioning the brand to an online-only presence. The physical stores may be gone, but the brand lives on digitally, a ghost of its former self haunting the internet rather than the local strip mall. But before all of this, there was one more twist. Enter Ryan Cohen, the billionaire founder of Chewy and chairman of GameStop. In early 2022, Cohen bought a 9.8% stake in Bed Bath & Beyond. Retail investors, still high on the GameStop saga, saw this as a potential turnaround moment and piled in. The stock price surged over 60%, with many hoping for another meme stock miracle. However, Cohen wasn't in it for the long haul. After pushing for changes and criticizing the CEO, he abruptly sold his entire stake in August 2022, making $68 million. The stock plummeted 67% overnight, leaving retail investors reeling. Some even called for the SEC to investigate whether Cohen had manipulated the market.
The SEC investigating those surprise trades of Ryan Cohen's of Bed Bath & Beyond shares that netted him what, a nice $60 million profit?
$60 million. Yeah, not too shabby for Ryan Cohen. And I remember this so vividly because initially we saw shares surge and then completely fall on news of his sale. So not surprising to see the delayed timing of these SEC lawsuit, as it typically takes between 1 and 2 years. This did occur back in August of 2022, so that's why it's occurring now. But all things considered, I mean, Cohen did take a $120 million stake of Bed Bath & Beyond and had promised some changes to the overall company, then selling his near 12% stake in August of 2022, just days after tweeting positively about the company and making that profit, like you said, of around $60 million.
Was it all part of a larger strategy, or was he just cashing in on the hype? We may never know. So what can we learn from Bed Bath & Beyond's story? It's a tale of success, complacency, and ultimately failure to adapt. What do you think? Could Bed Bath & Beyond have done something differently to avoid this fate? Let me know in the comments, and as always, stay curious and keep questioning.